Welcome back, day traders. Wall Street aims to open a New York trade on an optimistic note on the high volatility. The stock market made efforts in the pre-market to recover losses incurred during the gloomy February. Macroeconomic data enables the stock indexes to get their second wind. A slump of shares in the banking sector set the stage for losses on Wall Street on Monday because investors worried about the chain reaction. Stock investors were unnerved and the benchmark indexes closed mixed. The Dow Jones closed 90 points or 0.28% down. The Nasdaq managed to gain 0.45% and the S&P inched down by 0.15%. The benchmark indexes traded sluggishly intraday but perked up following the release of the US inflation data. Futures on the lay indexes rose by 1.3%, signaling bullish prospects for North American trade. The S&P is expected to trade in the corridor between 3,850 and 3,990 points today. Silicon Valley Bank collapsed on Friday after a failed attempt to expand its capital. Investors were alarmed, wondering about the risk that the Fed's aggressive monetary tightening could have entailed to other banks. Market participants assumed that the U.S. Central Bank could soften its hawkish rhetoric. In turn, yields of the U.S. two-year treasuries went down. Investors are trying to strike a balance between fears and hope. The Unity sector grew by 1.5%, logging the strongest among the 11 sectors in the S&P 500. Besides, the companies sensitive to interest rates, such as the real estate and high-tech sectors, also gained ground. The banking sector was hit by sell-offs. The shares of a signature bank, which was terminated by the watchdog, were suspended from trading. The Nasdaq said that would remain halted until the request by the stock exchange is met in full. The shares of a First Republic Bank plummeted by 62%. In contrast, the shares of a Western Alliance and PacWest bankrupt nosedived by 47% and 21% respectively. Trading shares were suspended a few times. Charles Schwab tumbled 11.5% up and resuming trade after the financial services company reported a 28% decline in the average margin balances and a 4% fall in the overall client's asset in February. Top U.S. banks lost almost $90 billion in the stock market on Monday. As a result, the losses in the last three sessions equaled nearly $190 billion. At the same time, the market revised radically the expectations about the Fed's policy moves. At the present, traders foresee a rate hike by 25 basis points in March. There is also a 44% chance that the central bank will maintain interest rates at the current level. The striking fact is that the market expects the Federal Reserve to terminate the whole cycle of tightening, leaving the ultimate rate size at 4.71%, lower than the upper border of the current target range between 4.50 and 4.75%. The market turmoil pushed up the fear index. Overnight, the VIX index approached the highest level in the 6 months. Other indicators of the market stress also revealed signs of tension. I see Bank of America move. The index bumped market's volatility surged to a 14-month high. The market is still gripped by jitters, and the sharp revision of the interest rates forecast weakened the US dollar. In turn, gold spiked as a safe haven asset. The gold price has skyrocketed by 5% over the last week to $1,900 per ounce. In the light of such a revision, the U.S. bond market burst into a roller coaster. On a Monday, yields of a two-year treasury stumbled most sharply since the crash in the stock market in 1987. The scale of the price swings was mirrored in the MOVE index, which recorded the wildest volatility in the bond market since 2009. And this burst of volatility exceeds the most turbulent periods during the pandemic and the shock in the repo market in 2019. The red-hot CPI could summon market expectations for the Fed's pause. The data released today was in line with the market consensus. The annual CPI in the US slowed down to 6% in February from a 6.4 in January. It's the lowest reading since September 2021. The matches the median forecast. Food and energy prices grew at a slower pace. Prices of second-hand cars and trucks went down. On the other hand, prices of electricity and accommodation increased. The core inflation, excluded food and energy prices, inched down to 5.5% from 5.6%. The CPI grew by 0.4% in months, following a 0.5% increase in the previous months, in line with the expectations. Inflation metrics are still far away from the Fed's target level of 2%, but the market could be pleased with a fresh CPI. Amid the lack of inflation surprise, the market is focused on the banking sector. The news on the banking sector could rule market sentiment today. The regulators might come up with a mutual claims that CVP problems were not detected in due course. Apparently, the Fed's power to sustain financial stability contradicts its mandate for low inflation and full employment. Federal Reserve Board announced that Vice Chair for Supervision Michael Barr would lead a diligent, transparent, and fast review of the suspension and regulation of the Silicon Valley Bank until May 1. Fed policymaker Michael Bowman is due to speak tonight. Her comments on the crisis are highly anticipated. The currency market is also overwhelmed by high volatility after a collapse on a Monday. The US dollar index recouped its losses in the pre-market, having climbed by 0.3%. The index settled at about 103.80, and the intraday corridor for the instrument is seen between 103.30 and 104.20. On a Monday, the US dollar index fell by 0.94%, so it's licking its wounds today. Yields over short-term US Treasuries are also recovering. A retracement after yesterday's rally is common for all currency pairs, in particular the euro, the sterling, and the yen, trading against the greenback. The bullish momentum for the US dollar looks muted. In theory, dollar bulls might soothe their nerves because the fresh CPI remains way above the Fed's target level. The key question is that investors doubt about the Fed's efficient policy moves and rhetoric. The efforts to curb inflation by high interest rates look ample. It looks like breaking one spare part while fixing another. The stability of the banking sector is extremely important, so the US Fed must mull over all factors. The outlook for the US dollar is uncertain, at least until the Fed's policymakers share their views on further policy moves. That's all on Michelle Bowman today. The Canadian dollar has been able to recoup all losses incurred after the policy decision by the Bank of Canada. The loonie has been developing a rapid advance since Monday, having slipped by 0.3%. The USD card pay is trading at about 1.3680, within the intraday corridor between 1.3650 and 1.3750. The loonie owes its strength to a decline in the US dollar. Canada's financial authorities supported the domestic market under the total sell-off of the banking stocks. The regulator said that it was stepping up control over financial conditions of domestic banks. On the flip side, the Canadian dollar's advance is capped by falling oil prices. OPEC upgraded its forecast of oil demand in China for 2023, but left the global demand unchanged, citing potential risks of a decline in global demand. Brent crude futures sank by 1.7% to trade at $79.30 a barrel, and WTI tumbled by 2.5%. On Monday, the benchmark rates fell by the lowest level since early January and December, respectively. The crypto market is showing remarkable resilience. Bitcoin extended its growth by another 5.7% intraday and spiked to $25,900. Ethereum climbed to $1,700. Popular altcoin appreciated by 3.5%. The crypto market is developing the rally of hope. Of course, there are fundamental factors such as the opposite correlation with the US dollar index, the prospects of the termination of the tightening cycle, and rescue of Silvergate and CBB investors from annual losses, and a new liquidity package worth $25 billion. Nevertheless, the news on the crypto is still worrisome. The US Justice Department launched an investigation into another stablecoin, Terra USD. Meta is shutting NFT on the platforms on the back of the crypto collapse. On top of that, large crypto exchanges are targeted by regulators. Crypto investors are considering two scenarios. If the US Fed acts in line with the expectations and hits the pause button in rate hikes, risky assets will receive the second wind. Softer financial conditions for cryptocurrencies will propel a rally. On the other hand, disappointment will push crypto assets sharply down. Under the first scenario, Bitcoin might climb above $28,000 or even $30,000. In the second case, the price could sink again to $18,000 and even $16,000, as all pitfalls of the crypto market will resurface. The market is still unnerved, and a new rally drives turbulence. As for the intraday outlook, Bitcoin surpassed $25,500 in confidence. If this high is settled, the token could jump to $27,200. Otherwise, Bitcoin might thread to the $24,200. Please evaluate all risks and make a sensible trading decision. See you online tomorrow.